Welcome to another edition of Treece Talk with your host, David Treece. Today we discuss who we work with to better serve you and the latest market and economic news. My name is Robert Robleski, Business Development Manager at Treece Financial Group. We will be taking your questions and comments through the Q&A and chat functions located on your screen. We look forward to hearing from you. Also, visit our website and social media sites for updated articles and events. On Thursday, November 3rd at 11 a.m., Harshita Kalra and I will be hosting Technology Talk, getting started with AdviceWorks, My Roadmap, your interactive tool to assist with financial planning and goal setting. Thank you. Now, let's welcome David Treece, Investment Advisor Representative, who has been serving your community and beyond for 30 years. David?
Welcome, everybody. I always feel old after that 30 years. Well, thanks for joining us again, another Treece Talk. We do these typically every 2 weeks. Happy Diwali to everybody who's celebrating Diwali. Harshita's training me. I have my diyas and I'm lighting with the mustard oil and not setting anything on fire this year. So happy Diwali to everyone. I want to make a big announcement here that we have talked in the past about creating these online communities. We actually got started with one company that I was super flattering that somebody reached out to me about all of the work that we're doing, helping older people in many cases, people who are aging alone, and they do online communities. We have found a vendor who is national that is really well developed. And just to let you know, we've picked up with this again, and you are invited to join our communities online. And we're going to be creating several of them. So if you go to our website, Treece Financial Group, you can see the solo ager. We've created a community right now for people who are aging alone or possibly at risk of aging alone. It could be anybody who's concerned about aging issues. But the idea is that this is an online community because we are trying to put together not only the resources to share if you are concerned about who's going to take care of me when I'm older, but a way to communicate with other people, other professionals who might be helping you, or other people in the same situation. It's like, did you use this transportation service? How did it go? Well, you can actually have that kind of a forum. And then also we will be doing some of the classes that we typically do on some of these topics. But the idea is to build an online community here for people who fall into certain niches. And this can be national, actually, so that we can just share the wisdom, share the resources, share the stories, and also like all of the people that we know who can help you. And I have so many stories, as those of you who know me over a long period of time, somebody says, I need to go into a medical procedure, a colonoscopy, cataract surgery, and I need somebody with me and I'm alone. Who's going to be there? It can't just be dropping me off and me calling somebody to pick me up. There are concierge services, there are transportation services, there's a rent a grand kit, I call it. There are, of course, all the nurses' aides. There are people who can help you age in place. There are people who can help you find independent living, other housing things, places to live, and senior move managers, people who will even help you move. All sorts of resources out there. And more and more and more, somebody to help pay the bills, literally mechanically. And for people who are really up in years who can't do it. So there's just tons of services out there. We don't want you to necessarily have to Google and try to figure it out on your own if we can put these vetted, recommended resources here. And then if you can share your resources, I always ask this to my clients. I've got people who've recommended doctors, dentists, whatever services out there. So the idea is to put this together in a community. You can log on, be a member, and have access to these resources. We have another one for older LGBTQ folks called La Vida Pride. We've had the idea to do another one for adult children with aging parents, ACAPs, as I'm calling them. I mean, these are the people who really have to reinvent the wheel unnecessarily, where it's like, okay, my mom and dad are getting really old, and what do I do? What documents do I need? What conversations do I need to have? When do we talk about taking the keys away so they're not driving if they're going to be in danger? communities, like share the stories, share the resources. And so we're putting those together, and it's in a risk-free environment. It's not advertising oriented, not like Facebook, no trolls. No, it's designed to be vetted, curated, supportive, community oriented. So we've got those going right now. We have a poll too. Sometimes I go over this. Have you visited missingmoney.com? And I find this interesting. When I start working with people, I mention that this is a completely legitimate source of the state's treasurers, and they will go ahead, and if money is turned over to the state, I'm dealing with this right now from one company that's not processing a death claim, as well they should, and they say it gets turned over to the state. I have frequently found that things are turned over many times. It's not just, like 3 or 4%. I would say probably like 20% of my clients have had things turned over to the state. It has always been small. It's usually a deposit that gets turned over and it's forgotten. But often if you go on there, you'll see that it's life insurance, that there are life insurance claims where somebody's passed away, somebody's named a beneficiary, and they can't locate that beneficiary. So that could be more money. So it's kind of a fun thing to do, and it is legitimate. You can put in your own state, like here for Florida, or if you lived in another state, you can put in that state and it will search there or send you to that website. You can claim online with the claim form if you are eligible to claim. And it could also be something that you might have be able to claim from a deceased relative. I actually did this for my mother. My mother had money after she passed away. I found it was a small amount and I didn't know what it was at first. And I claimed for it. It was a bit more of a hassle because you have to show the death claim and that there was a will or was it probated and all of that. But obviously, if it's a larger amount of money, it can be worthwhile. In fact, there are companies that do this. You may be approached. And I've had that happen where a company will call me and say, we're trying to track down the relatives of so-and-so because they found money and they are going to charge a commission to help somebody recover that money. And this is something that you generally don't pay for. You can do it on your own. You log on and do the claim form. If it's complicated because of trust issues or beneficiary issues, it could be worth paying somebody to do if it's that complicated. But anyway. And today I'm going to talk before we get into the markets. Something has come up, and it comes up on occasion. Who we are, how we work with our clients, how we are different, who are the various players. Sometimes this comes up because there are just so many compliance issues involved, so much paperwork. And I want people to have a base understanding, at least. For example, Treece Financial Group, we're one company. We are independent investment advisors, financial planners. We have a broker dealer, Cetera Advisors. They oversee us. Everything that we do has to be basically approved by them. Our reach out, our public appearances, advertising, all of the investments that we offer. We can't have some unusual investment that hasn't approved. On rare occasions, some venture capital will reach out and call and say, oh, we've got this great opportunity. Your clients may be interested in it. Doesn't work that way. It has to be approved, vetted, and there's due diligence done. So anything that we're offering has to be approved by our broker dealer. That's for the public's protection. It's a great rule. We actually had a Canadian mutual fund company, totally mainstream and legitimate, but they had to go through the process. They wanted to be on Cetera's platform, but that means all of the due diligence. So that's who Cetera is. They don't quite matter directly as much for our clients, but it's very important for us is how we function, processing business, opening accounts. Those accounts are reviewed. We get audited every 2 years. So there's a lot of built-in protection, a lot of regulation for the advisors, for the public through us as advisors, which is another key point. We don't have to be regulated this way. We could choose not to have a broker dealer and be independent, further independent as setting up our own registered investment advisory firm. And you have a lot of those out there. And some of them are very high quality. I don't mean to say anything negative, but there is less regulation. And they do not have to go through all of the approvals at the same level that we do. And they still have to follow the rules. They can get audited by the state or by the SEC, but we have to go through a lot more hoops having a broker dealer. And so again, that's for the public's protection. Another important thing I want to point out, one of the main players is Pershing that we use. Pershing is a custodian. They're part of the Bank of New York Mellon. And the point there is, I call this the Bernie Madoff rule. Your money, it has to be at a third-party custodian. The way I express this is, if you're investing with us and I'm hit by a bus, your money isn't with me. It's not with Treece Financial Group. It's at Pershing typically, or another fund company. It could be an insurance company, but it's always at a third-party custodian. You could call them directly. They want you to always go through the advisors, but if I'm not here, or you go through Cetera, our broker dealer, the point is there's some protection there. You don't write checks to Treece Financial Group. You write them to our broker dealer, or you write them to, it's to us, or to, intended for us, like a fee, or if it's for an investment, you make the check payable directly to Pershing, or again, the mutual fund company, the insurance company. So that's just an important protection again for the public. And that's, Bernie Madoff, the famous scam artist, Ponzi schemer, didn't have that. People were making checks payable to him. He was producing false statements. Everything went crashing down. And people thought, how could you get away with it? Well, one good regulation is you have an independent third-party custodian who's responsible for the safekeeping of your money, for your performance reports, your tax documents, your online access, and Pershing has been phenomenal for that. So that's how we're set up. And another reason I bring all of this up is I want to point out how we are different. I think some go, for example, we say fiduciary. We are definitely fiduciaries, meaning we have a duty of loyalty to all of our clients, no conflicts of interest, utmost care. And we take that personally to a very high degree, where we're really concerned about our clients' welfare, and we do a lot of advocacy work. I'm doing a lot of it right now. And sometimes we fight banks and insurance companies to get things done. We're on the phone a long time on hold. The service levels aren't always what they should be. Generally, we've got inside people we can talk and get any problem solved. But others do not do this. And they are absolutely not oriented along these levels. Some are not fiduciaries. They have a lower suitability standard. They are more sales oriented. And I come across it all the time. I've made some criticisms of people who are under quotas, production requirements. I see this often in bank outlets, younger people, high turnover, less experience. And so I say for this industry, there's no substitute for experience. And even though I joke about being old, our structure right now is like apprenticeship, that I want people who are coming in here, and we have interns, we have younger people, and I want them to learn how to do this the right way and not have to just get out there to produce. And often this industry was structured that way. It's like, here's the phone book, check your address book, who do you know, call them, cold calls. We do not want any pressure, no sales pressure, none of that. So I think we are positioned much better to do a better job for our clients and to help people. And that really matters. And of course, that's why we have long-term, lifelong client relationships. We get a lot of referrals, a lot of repeat business, so to speak. And then that's what we want. That's the right way to go. So we're very different and from many others out there in this regard. There are other differences too. In fact, I'm writing this series of books. They're called Fast Financial. We're making a lot of progress. And one of them is on choosing a financial advisor. And these are all short volumes. They're designed to be 25, 50 pages. And the difference is, how do you do background checking on an advisor? Also things like, fee only versus fee based. Like the fee only ones will not work with insurance products. And I think that can be a problem, where if you're trying to manage life insurance, long-term care, guaranteed lifetime income through an annuity, and then they're not even licensed to provide any of those solutions, and often will talk against some of those solutions because they're not licensed. And I think it's a conflict of interest not having those licenses. And yet often the public perception is the opposite, that because those are insurance products and we get commissions on those, that it's like a conflict of interest, when if that's the right solution, we are fiduciaries either way. We can charge hourly, we can charge a flat fee, we can charge subscription fees, we can charge for assets under management, we can receive commissions. I'm an accredited investment fiduciary. It makes no difference how we are compensated. We still have that fiduciary duty, and there is no inherent conflict of interest in any of these. We just have to always avoid a conflict of interest, no matter how we're compensated, and always do the right thing. And that, again, our broker-dealer supervises us. So if we are making one recommendation over another, we have to justify that. So what's happening in the markets? And this is going to be an interesting week. We've got two key reports coming out, one on Thursday and one on Friday. And Thursday is going to be the new GDP numbers. And it's interesting where we've had some GDP growth. We had a couple negative quarters earlier this year, which is basically how we define a recession, but that's very simplistic. And this is really defined after the fact. And we are expecting some positive GDP growth. So that's going to be kind of interesting. But Fed is looking for signs that the economy is slowing down, and so is the stock market, so that they will reduce the interest rate increases. Right now, we think that we are still expecting, and the market is pricing in 0.75 of a point interest rate increase for November, possibly another one in December. Maybe at that point, they may not have more increases. One of the interesting statistics, one of the biggest ones, is the CPI numbers we will get on Friday, the Fed's preferred measure. And so that is one of the key clues. A lot of the decisions that the Fed makes is going to be based on this data. And if they see that they are getting a handle on inflation, and there's a lot of reasons to believe we are based on other statistics, other measures. For example, the supply chain. We've had all this shipping backlog, like particularly Los Angeles, Long Beach, and that's basically all worked its way through. Inventories are higher. And so what that can mean is that their prices may go down if inventories are high. So there are other reasons to see that. Of course, we've got the energy prices going down. However, that's not part of this, the statistics that the Fed likes to look at. They do this X food and energy prices. So that's going to be a big factor in going forward. I definitely think that once the worst of the inflation is over, once it's under control, that we will see the end to the interest rate increases. And that also will probably cause the stock market to stop having this correction, not necessarily predicting a bull market, but that things will stabilize. But in the meantime, we're still expecting a lot of volatility. And the last week, we had a positive week again. It's kind of significant. The S&P 500 was up 4.75% for the week. But before that, the market had been extremely oversold. We had 7 weekly losses out of the 9 previous weeks. So we had really a down market this year. As of yesterday, the S&P 500 was down year to date, just over 20%. The NASDAQ right at about 30%. So these are significant declines. The amazing thing I've said before, the Bloomberg US Aggregate Bond Index down nearly 17%, which has never happened before. Generally, the worst it's down is like 3%. On the inflation note, I want to say that there are a lot of forecasts that inflation is going to go way down. And while we look at that as a positive, there could be another shoe to drop on that, that if we could get into a recession, the question is, will it be deep? Will it be short? But a lot of the forecasts from the other market measures are showing that we will be getting, even as soon as next year, into a much lower inflation environment. And some of the economists I'm following and other money managers are already starting to say the Fed has done too much too fast. The criticism has been all along, the Fed was too slow, and they waited too long. They were wrong about inflation being transient. And so they waited too long, and these 75 basis point increases are now, there's a concern that it's going to eventually slow the economy down too much. And there's even talk about when will they start cutting interest rates. Will that be sometime towards the end of next year or the following year if the economy slows down too much and they need to stimulate the economy? We've just had these incredible imbalances. That's the bottom line here. The lowest unemployment in 50 years, highest inflation and interest rate increases in some 40 years. We get these kinds of statistics. And most of this is simply due to the shutdown of the economy, the pandemic, the government spending to support the economy during the pandemic and the shutdowns, and a lot of money coming into the economy, and then working this all out and getting a balance again. One of the interesting things that I don't usually talk about is the housing market. And I have an interesting article here. A lot of people are questioning because the values have gone up so high, so fast. And now we've had interest rates virtually double. What's going to happen to the housing market? So here's a report I'd like to share. High mortgage rates and recession fears are hurting home prices. So expect growth to be flat this year, one expert says. This is Joel Kahn, the vice president and deputy chief economist at the Mortgage Bankers Association, so a major organization for the housing industry. Our forecast is for home price growth moderation to continue. So that's not a decline, not saying that we're going to bubble at all. It's just that the price growth moderation should continue. He said that during the organization's annual conference in Nashville. Home prices have already begun moderating, according to the Case-Shiller Home Price Index. Home prices fell month over month from June to July for the first time in 20 years. We've had this decrease. The latest numbers, which will be for August, will be reported later today. With a recession likely in the cards on top of mortgage rates near or above 7%, we've already seen a pretty dramatic pullback in housing demand, he said. So, but they are predicting that the interest rates are actually going to go down. The 30-year fixed rate averaged 6.94% last week, as compared to just 3.85% a year ago. The MBA, the Mortgage Banking Association, is expecting rates to come down to 5.4% by the end of next year. So expect national home price growth to flatten out in 2023 and 2024, he said. This might be a silver lining for some as it brings home prices back to more reasonable levels. A flattening of home price growth should allow households to catch up in terms of wages and savings to afford homes that are presently too expensive. This is what I'm going to get into right now, really shows the push and the pull and how one thing affects another. He warned that some markets may actually see home prices drop. Well, we're already seeing home prices, home values fall in some markets, like the pandemic boom towns, Austin and Phoenix, and as well as ones that were already previously expensive, like San Francisco Bay. Still, and here's my point, even with price drops, don't expect a surge of inventory as people sit on their ultra low mortgage rates that they will likely not enjoy again in the near future. That's keeping people trapped in their homes in a sense, unless they're going to sell, move to another location, and pay 100% cash for a new place. So that's one effect on the supply of housing. According to June data from the Federal Housing Finance Agency, nearly a quarter of homeowners have mortgage rates of less than or equal to 3%. And the vast majority of owners, 93%, have rates less than 6%. That is, rates less than the current rates. So on top of that, supply is likely to be tight too. Sellers are said to be striking on strike, meaning and not selling their homes as they see others forced to cut list prices to woo buyers. And builders are also getting spooked, signaling an intent to slow new construction. That's somewhat to be expected because of the higher interest rates, the mortgage interest rates. Nonetheless, demand for housing should recover eventually, given that there are a lot of people who will soon need to be in the need of a home that they can own. This is another interesting demographic statistic. They estimate at the MBA there are 50 million people in the 28 to 38 age demographic, of which some of many are likely to become homeowners in the future. For those under 35, the homeownership rate is only 39%, and that increases as people get into the next aging bracket, 35 to 44, that goes up to 61%. So the bottom line is they're fairly confident if we stick to these trends, you'll see very supportive demographic driven housing demand for a good number of years. So people still have to have a place to live, that's for sure. And these things will probably become more normalized, regularized, but we've had all of these extreme factors in play here. I'm going to start to wind up at a couple of other announcements, things to share. We've had also the announcement of the new IRS regulations for retirement plans. So next year, just like we've had a huge increase in the cost of living adjustment for Social Security recipients, we've also had a huge increase in the amount that you can contribute to 401k plans. So it's actually up 9.8%. Starting next year, you'll be allowed to contribute up to $22,500 into a 401k, 403b plan, or most 457 plans, or the TSP, the Thrift Savings Plan for federal government employees. So that's up $2,000 from the current limit. And then there's also, if you're over 50, a catch-up contribution that's also going up in 2023 to $7,500. So for somebody over 50, you combine those two, and the maximum contribution now will be $30,000 into a 401k plan. And of course, that does not count matching contributions from an employer. Now, that's a lot of money, obviously, that now somebody can save into a group retirement plan. Another thing that has changed, and that I'll talk about this at my Social Security seminar, is that they've also increased the earnings test. And so one of the things is, if you were to take Social Security claim your Social Security benefits before your full retirement age, and you continue to work, you are subject to an earnings test. And what that means is, if you make too much, as reported on your taxes, the next year the government starts to withhold money from your Social Security check. So we discourage people from doing that generally. We want you to wait until your full retirement age to claim Social Security, generally speaking, or if you claim it early, the idea is to take it because you're actually retiring. So right now, for next year, the 2023 retirement earnings threshold, the earnings test, as I call it, is increased from $19,560 to $21,240. What that means is that's all you are allowed to make if you are working and claiming Social Security without there being a deduction from your Social Security benefits the following year. If you make more than that, $1 of benefits is deducted for every $2 earned above that $21,240 limit. And that earnings test applies even to survivor benefits. So, which is, it's hard. If you are a married couple and somebody passes away and you want to inherit that person's Social Security check, and you're younger, you're still working, you're still going to be subject to that earnings test, unfortunately. And it also gets reduced, that your survivor benefits. So you still will be eligible for those survivor benefits, but if you wait until your own full retirement age, you'll get 100% of those benefits, and you won't be subject to the earnings test if you continue to work. So that's an intricacy of the Social Security system. So sit tight with the markets. If you've got any questions, anything we can help with, don't hesitate to reach out to us. And think positive, be positive, focus on the things that you can change. Don't let all the negativity or the markets out there bring you down. And that's it. So we will see you on the next Treece Talk 2 weeks from now, or on the communities, or at one of our webinars. So thanks for attending. Here we go. If not to make the world better, what is money for? Positive thought. Bye, everyone.